Elaine or Jim?
Jim, go ahead.
Okay. When I think about innovation, I tend to think about it in two buckets. One, from a product innovation perspective, which may or may not include technology. And then the second would be a technological innovation. The second category being an innovation that it's going to extend and add a competitive advantage to your current business model. In the first category of product innovation, you could have something, Southwest Airlines arguably competes on a no-frills model, but they've been able to do that with obviously low cost. Airplane service obviously existed, but they've been able to innovate in that market. Whereas a technological innovation may be the iPod. MP3s already existed, but they were able to take it to the next level with better marketing and a better user interface, et cetera, and it's gone gangbusters for them. And then thirdly, if everything else, if it's not a new disruptive innovation in the first model, such as Christensen would talk about in the innovator's dilemma, or if it's not going to extend a competitive advantage in your existing business model through technology, then everything else I view as systematic, meaning it really doesn't do anything but just help you a little bit. If you're starting a business today and you have email, that's no advantage. If you're starting a bank and you add internet banking, that's no advantage. You have to do it to be in business. Now, over the last 18 months, what's exposed an opportunity for us is the financial crisis. As I mentioned, we provide a platform to banks that allows them to do a small business lending in a more efficient manner. So businesses have been lending to banks, banks have been lending to businesses for a long, long time, but we would argue they haven't been doing it efficiently. Well, what we know that's going on is that for example, larger companies, access to capital has dried up because of the commercial paper markets have dried up. Banks have gone headfirst into lending real estate and commercial real estate, as we all know, and we know what the result of that is. One of the fallouts of that is that smaller businesses, mid-cap businesses, have not been able to get access to capital. Well, banks are trying to get back into commercial lending, but they have this dilemma that all of their people, for the most part, are real estate lenders. So how are they going to lend to small businesses that only need a $1 or $2 million loan, which, by the way, if you're getting a $2 million loan, represents about, a company with 20 million or so in revenue. The preponderance of businesses in America fall in that category. About 8 million of them fall in that category. So what we have identified is this opportunity for banks that are willing and have the balance sheet to do more commercial lending to embrace our technology and use it to lend more efficiently to businesses. And our investors believe that, we believe it, and really in the last 24 months, that's when we've had that 6x growth, when these capital markets have fallen apart and business capital has dried up.
And you would certainly think that a financial transaction software company would have just been crushed by the last 2 years.
That's right. And I would say, though, also, we're in that second category, adding a competitive advantage through technology for a bank, extending their business model. It's not disrupting anything per se.
Right?
Yeah, really to tie that all together, the three things that I think we're seeing that are most significant fall into, I guess, three general areas. They've all been mentioned here, but just to kind of round them up. One is the continued technology development, particularly in the area of cloud computing, although it's become a little bit of a buzzword. But those types of technologies that are allowing some incredibly rapid scaling of businesses and of transactions that are just orders of magnitude different than we've seen before. There's also a lot of financial innovation that's going on, and a lot of different ways of that funding markets are operating, or beginning to operate, kind of out of necessity because the old ways aren't working. A lot of that is driving and underlying and supporting some of these technology innovations. And then the third major group of things that we're seeing is differences in the way that you communicate with your constituencies, whether that's your customers or your suppliers or even your employees. And I think that's where some of the social network and in particular, what's most striking to most folks who work in large corporations is lack of control that they now experience over their methods of communicating, in particular with customers. As we see all of those three play together, it produces some very interesting dilemmas and opportunities for innovation.
There's also, in addition to new products and technologies, there's a number of new business models and processes that you need to have in place to be successful. Let's talk a little bit about how you've seen that come to play in your businesses with respect directly for initiatives that you guys are seeing undertaken at your companies or companies that you're familiar with that might be a good example around business processes, business models, business practices that have changed or have had to have changed as well because of they had to be innovated. And if you could tie that back into what metrics are meaningful in those new models that are like success metrics.
Start. I know you've got some interesting stuff.
Well, ours is, as I mentioned, working with the banks. Our end customer, the one that pays the bills, is the small business customer. They're the ones that are using, ultimately through the bank, this platform. So in the context of a business model of the bank, what we're seeing is that they are leveraging our software as a service platform. They're leveraging this cloud environment that we've established for them to offload some of these administrative tasks that they would otherwise be burdened with. For example, if anyone in here, I'm sure you have gotten a loan from a bank, a commercial loan, if you really look at the spectrum of lending you have, I'm able to walk in the door and with a minimal credit score, not a minimal credit score, but just running a credit score and perhaps a personal guarantee, you can get a $100,000 line of credit, right? And then they may ask you for your financials once a year and they stick it in their drawer, they don't ever look at it. The next upper level would be asset-based lending, where a bank is maybe not going to do that unless it's a $5 million loan. They're going to send an auditor in every quarter to do the counting, et cetera. But in the middle, the $20 million company or less are underserved, and they're, we believe, primarily underserved because the bank, A, doesn't have the people or the processes and the time to really do the intensive monitoring on that account and that collateral as they need to. So what we're seeing is that they're recognizing that, and they're able to recognize that if they can offload that through a technology interface, have the technology as a front end to do this monitoring and be in their customers' receivables and see it on a real-time basis, then that's beneficial. And then if they can leverage a virtual workforce per se and do the back office administrative work, then they're all for it. And it's even better if they can get their customer to pay for all that. So we're seeing the banks look at ways to offload some of the manually intensive work through leveraging technology.
Cool.
It might be, in some respects, very similar to the banking industry. In another area, maybe a little bit different for telecom. Even in a down market, we're seeing generally revenue growth in the 2 to 5% range for the telecom industry in North America, an industry that generates about $200 billion a year in revenue. Most of the operators that are active in the space have the financial wherewithal to fund their operations, either from ongoing cash, free cash, or from existing credit lines because of their legacy relationships with inter-exchange carriers or with other equity partners. The bigger challenge that carriers are facing in terms of funding is the open-ended expense associated with technology evolution. As carriers have moved from 2G or GSM architectures to third generation or wideband CDMA and like architectures to what's coming now, which is 4G. 4G is going to place 50 megabits per second in your handheld device. The capital associated for rolling out those grades of service nationwide are tremendous. They're in the 10 and 11 digit range for the industry. So the telecom industry, the internet/telecom industry is though facing a real dilemma when it comes to contemplating the scale of these capital requirements when they have to do it by themselves. So you're seeing as we anticipate this evolution of grades of service, not only to include throughput and more connectivity, but also a more rich experience through applications and services. Carriers are embracing the idea of developing ecosystems of partners. Apple iTunes, the iTunes Store is an example of a primary brand, a tier 1 brand that realizes they can only do so much for a marketplace and they have to expand their reach and their scale by offering like-minded partners the opportunity to continue to add value to their brand. So not only are we developing ecosystems of applications and services for our customers, but our customers are in fact developing similar environments for their own customers. So what we're seeing is a plethora now of environments, of systems, of communities of interest where carriers are investing money and they're helping their partners invest money to create like-minded applications and services for targeted communities of consumers. And it's we're just scratching the surface truly on what the investment in that kind of environment is going to look like.